ESG virtue signaling is snake oil. Shareholder capitalism beats stakeholder capitalism. If you care about private property and laissez-faire capitalism, you will run a mile from ESG, environmental, social, governance factors that promote stakeholder capitalism. In the past, you could invest easily without funding social justice activism, since that was niche. However, with so many companies and funds jumping on the bandwagon, you now have to actively avoid them. The false god. There are two thorny truths about ESG. 1. There is no agreement on how to grade firms, and there never will be. 2. Ideologically constrained portfolios do not beat unconstrained portfolios. ESG is a virtue signaling buzzword that distracts from fundamental analysis and allocative efficiency. The ruse rests on subjective assessments rather than concrete attributes. It muddies fiduciary duty and lessens accountability for portfolio managers. Further, ESG is a tool for progressive ideologues to guilt trip and hustle private companies. Amid social media and trending hashtags, the specter of finger-pointing, mass hysteria, and boycotts is ever present. Risk-averse firms avoid confrontations, and chief executives have fallen over themselves to embrace ESG and preempt the woke brigade. The ideologues are creating for themselves lucrative positions as gatekeepers and consultants. They are establishing standards boards with the promise of keeping the mob at bay, so long as firms follow fashionable dogmas and have the right stamp of approval. Public pension funds, such as the Canada Pension Plan, are especially vulnerable to this politicization and malinvestment. See Chapter 4. A voice of reason. There has been widespread ESG adoption among financial professionals, likely because they see a fee-generating opportunity and ominous regulatory pressure. The Forum for Sustainable and Responsible Investment estimates that by 2020, 1/3 of the world's professionally managed assets, $17.1 trillion out of $51.4 trillion, had gone through ESG screening. The proportion continues to rise. However, even proponents acknowledge no consensus over what merits ESG recognition, and quantifying criteria opens a can of worms. The CFA Institute, the world's most prominent financial professional association, acknowledged this in a 2021 position statement. ESG disclosures and data, quote, require further standardization and refinement to improve the quality, consistency, and comparability of material ESG factors, unquote. The CFA, quote, does not support mandated integration, nor should regulators, unquote. Writing on the CFA blog, Jordan Bozlego of Baliazny Asset Management dismisses the term wholesale, quote, ESG is such a broad and haphazard concept that without strong fiduciary standards, it risks becoming a convenient excuse for those same fund managers to underperform their benchmarks while also charging higher fees, unquote. Meanwhile, proponents have been moving the goalposts. Mary Jane McQuillan, head of ESG for ClearBridge Investments, concedes, quote, ESG's foundational ideas were originally discussed as ways to improve investment returns, unquote. While a few believers remain, sophisticated apologists such as UK-based commentator Joachim Clement downplay the damage, quote. Not only do exclusionary screens not work, they are counterproductive. The next iteration of ESG was the best-in-class approach, which mimics conventional strategies as closely as possible, unquote. Gone are the grandiose upsides, but perhaps the gravest public relations I saw for ESG came from a 2020 Michael Moore documentary. Planet of the Humans identified the counterproductive activities of self-proclaimed environmentally friendly investment funds, even those backed by prominent nonprofits. The climax of the film was the closure of funds in anticipation of crippling publicity. The age-old debate. The ESG label is new and trendy, but it is actually a continuation of the long-standing rallying cry against the Friedman Doctrine. This derives from a 1970 essay by the late University of Chicago economist Milton Friedman. The social responsibility of business is to increase its profits. His essay still appears in business school readings and with such lucidity and relevance that students are inclined to assume it just came out. Friedman defended the ethical value of profit as a firm's objective, and he saw through the facade now referred to as ESG. Quote, businessmen who talk this way are unwitting puppets of the intellectual forces that have been undermining the basis of a free society. The doctrine of social responsibility involves the acceptance of the socialist view that political mechanisms, not market mechanisms, are the appropriate way to determine the allocation of scarce resources, unquote. The tendency of investors to use their money in irrational ways is not new, so emotional appeals are to be expected, and this has spawned behavioral finance as a field of study. People do not separate their values from their portfolios, and the flip side of ESG investing is sin stocks. As noted on the Kaya Association blog, which focuses on alternative investments, sin stocks, tobacco and gambling, for example, run counter to polite tastes but, quote, have higher risk premia and so higher returns than other stocks. This is a lasting effect, not a window briefly closed by arbitrageurs, unquote. Financial author and retired academic Donald Chambers, once a mentor to me, writes that, quote, impact investing has long had a reputation for earning below-market financial returns, unquote. In other words, investors pay for their personal tastes. Investors can earn higher returns by accepting the distasteful or lower returns by pursuing the positive spillovers. Similarly, many investors opt for hedge funds as a status symbol when discount brokers would be a better fit. Impact investing via ESG factors is a luxury some people indulge in, akin to charitable giving. Research from Boston College, though, is pessimistic about ESG achieving its objectives. Quote, stock selection is unlikely to stop smoking, slow global warming, or change the behavior of terrorist countries, unquote. To rub salt into the wound, ESG standards hurt Canadian energy companies, especially when they approach insurance companies that prioritize net zero emissions. At the same time, ESG pressure has unintended reverse consequences. That includes encouraging firms to go dark, to delist themselves, and avoid scrutiny. Similarly, shifts away from Canadian energy firms play into the hands of state-owned enterprises, such as those of Russia and Saudi Arabia, that care not for transparency. Where stakeholder capitalism leads. University of Virginia professor Edward Freeman kickstarted stakeholder capitalism in 1984. It was what ESG seeks to measure, and it goes beyond corporate social responsibility. The claim is that companies should prioritize stakeholders, employees, customers, suppliers, and local communities. The next step of this supposed enlightenment is diversity hiring over meritocracy, executive quotas for women, union members, and non-whites, and anti-competitive environmentalism, among other divisive policies. The outcome is politicization, conflict, and waste. Decision-making by consensus is time-consuming and unproductive. The virtue signaling of stakeholder or woke capitalism is an oxymoron. It stems from a fundamental misunderstanding, the false dichotomy and rhetorical trick of delivering value to either shareholders or stakeholders. In reality, when firms serve shareholders and engage in voluntary exchange, they generate profits and serve the wider economy. Unfortunately, this Trojan horse of social engineers crossed the gates at the 2020 World Economic Forum in Switzerland. The Davos Manifesto 2020 replaced the original from 1973 and endorsed corporate duties towards stakeholders rather than shareholders. At the 2020 event, McKinsey & Co. global managing partner Kevin Schneider defended the shift by glibly and misleadingly referencing influential 18th century economist Adam Smith. Apparently, Smith, quote, was very clear in saying that the responsibility of the business person was to give to the community and enrich everyone, unquote. The truth is the opposite, and the most famous reference from Adam Smith's The Wealth of Nations, 1776, is the invisible hand. This refers to the emergent order from a man's actions that, quote, promote an end which was no part of his intention, unquote. Quote, by pursuing his own interest, he frequently promotes that of the society more effectually than when he really intends to promote it. I have never known much good done by those who affected to trade for the public good, unquote. Corporate executives such as Schneider are undermining the most prudent way to run businesses, the shareholder value model. Accordingly, executives should focus first and foremost on the interests of the firm's owners. It is their firm after all. Shareholder primacy promotes competition in pursuit of profits for shareholders, and that is healthy. Firms do not exist in a vacuum, and they cannot thrive without compensating employees at market rates, maintaining good relations with suppliers, and providing customers with environmentally friendly products and services they demand. The rebranding, stakeholder metrics. Since 2019, when the US Business Roundtable backed stakeholder capitalism, later joined by the World Economic Forum, there has been rising awareness that this is a problem. Even ESG proponent David Ryan, writing for the Globe and Mail in 2019, likened the Business Roundtable stance to a public relations campaign rather than an honest, well-intentioned reform. University of Chicago professor Luigi Zingales called it, quote, at best, misleading marketing, at worst, a dangerous power grab, unquote. Resistance has come from many arenas, but the most important is investors concerned about their results. As Ian Madsen of the Frontier Center for Public Policy writes, quote, in perhaps a surprise to most ESG enthusiasts, and even to the general public and policymakers, ESG-sensitive funds have not outperformed broader index-invested funds, either in the short or the longer term, unquote. Such has been the strength of skepticism towards ESG and stakeholder capitalism that a quiet rebranding appears to be taking place. The new forgettable branding, stakeholder metrics for sustainability reporting, portends to allow the agenda to continue, but in a less forthright fashion. Clint Rainey, reporting for Fast Company, distills the criticism prescient at the 2024 World Economic Forum, quote, ESG, those letters stand for everything and therefore nothing, which makes it nearly impossible to establish fair, universal metrics, unquote. In your hands. Let us neither succumb to the consumer fraud that ESG drives higher returns, nor impose it via regulation. Unfortunately, Canada pension plan funds are going in the wrong direction, but you need not compound the problem with your own discretionary income. For those seeking better alternatives, I recommend following Texas-based Kevin Freeman and his Economic War Room show. Freeman is working on the National Security Investment Consultant Institute, NSIC, to equip and certify investment advisors in LSV, Liberty, Security, Values, Investing. His formal curriculum needs more depth, but he is at least attempting to offer a viable competitor to ESG. The Kaya Association blog, Portfolio for the Future, offers erudite insights on the evolving financial sector, and it appears to take a relatively agnostic view of ESG. My own firm, Econ Americas, is available for equity research, and you can be sure my team will not be swayed by ESG pleas. For those with a Christian bent, there are many resources available. Arthur Alley of the Timothy Plan is one, as is the Financial Issues newsletter. That being said, please be careful when hearing of investment advisors and portfolio managers who tout their conservative or pro-liberty bona fides. I know from firsthand experience that this is often a marketing ploy and branding hook that has little to do with allocation decisions or even authentic beliefs. I declined a partnership offer from one such firm. Replacing one ideology with another is not necessarily a path to higher returns. While I have not hired Nadine Wellwood of Cochrane, Alberta, personally for financial advice, I have followed her work over the years. I can attest to the sacrifices she has made for liberty. For the independent-minded person, she is a chartered investment manager to consider, and her YouTube channel, @Nadine Wellwood, is worth your time. Simply being aware of ESG and stakeholder capitalism is the crucial first step. Then you can read financial content with an astute eye, see through the gimmicks, ignore ESG ratings, and make your own informed decisions.